Good morning and welcome to the Bills, Bears, and the Bell Morning Edition deep dive. Thank you for joining us. Today, we're really undertaking a critical deep dive. We're looking into this high stakes market tension that's just absolutely defining the start of October 24th, 2025. We're pulling directly from a pretty comprehensive pre market briefing, the kind of essential market intelligence that really sets the tone for the whole session. The market right now, it feels less like an investment opportunity and more like a tightrope walk, like over an abyss of uncertainty. And our mission today really is to cut through that noise and figure out exactly what traders are positioned for and what that means for you.
Yeah, the tightrope analogy, it's spot on. What's defining the mood isn't just simple nervousness. It's a stark bifurcation. That's the central conflict we have to unpack. On one side, you've got genuine, robust corporate fundamentals. Companies delivering strong, specific results. Let's call that micro-resilience. But then slamming right up against that strength is this acute, pervasive, event-driven global fear, mostly around inflation and geopolitics. We're calling that macro anxiety.
Right, and the entire global financial system seems coiled, just waiting for some kind of release. The single catalyst, the thing that will resolve this tension, at least for today, it's the 8:40 a.m. Eastern release of the U.S. Consumer Price Index, the CPI. Everything seems to hinge on this number because, well, it has the power to either validate all that fear or maybe justify the rally we're tentatively seeing. So for this deep dive, we need to understand the current positioning, the consensus data, and crucially, the three possible outcomes.
Exactly. And we're going to explore some contradictions today. Like, why is the rate-sensitive NASDAQ leading the charge, even while the 10-year Treasury yield is back above that, psychologically key 4.00% level? That's a direct mathematical headwind for equity valuations. It doesn't quite add up on the surface. Plus, we have specific corporate examples, like the pharmaceutical giant Sanofi. They show how sheer product innovation can create a genuine shield against inflation fears.
It really proves the power of that micro narrative.
Okay, let's unpack this. Let's start with the battlefield itself, the pre-market trading action. So, if we look at the snapshot of U.S. index futures, say hours before the market opened on this crucial October 24th, what immediately jumps out is, well, we're not seeing a generalized broad-based rally, are we? It looks like highly selective optimism. Exactly right. The action suggests institutional money isn't just buying the whole market. They're picking very specific places to maybe hide or at least concentrate their bets. Look at the numbers as of the pre-market session. The NASDAQ 100 futures NQ are the clear leader. They're up a strong plus 0.61%. That suggests a renewed, maybe still tentative, but definite willingness to engage in risk, and it's flowing right into tech and high growth.
So traders betting on the mega cap tech names to power through.
Seems like it. Betting that cohort can weather any macroeconomic downturn.
Okay, and the S&P 500 futures, ES, they're higher but much more moderately, up plus 0.38%.
Right. That signals that dip buyers are indeed re-engaging. They're trying to restore a bullish technical picture after the volatility we saw late last week. It suggests there's money on the sidelines, waiting to move, but they're cautious, still cautious.
But the real story of this divergence you're saying is told by the Dow Jones futures.
Absolutely. They are significantly lagging the others, showing only a tepid plus 0.07% gain. Barely moving. It's maybe the most telling data point this morning. It immediately tells you that the positive sentiment is highly, highly selective. It's focused pretty much entirely on growth and technology, those micro-resilience stories we mentioned. And it is absolutely not being driven by some broad, cyclically oriented blue-chip rally.
Okay, let me just make sure I'm following that logic. The Dow, it's heavy with industrials, financials, older economy cyclicals, the companies most directly exposed to things like commodity costs, supply chains, interest rate sensitivity for their, CapEx. So the fact the Dow is barely moving while the NASDAQ is up over 0.5% implies macro anxiety is essentially keeping the older economy grounded. While the market kind of hides out in those mega cap tech names, believing their specific stories or balance sheets will insulate them from the global gloom, is that it?
That's precisely the tension. You nailed it. If the Dow were leading, we'd infer genuine faith in the broad economic cycle, a willingness to accept cyclical risk. Since it's lagging so heavily, the positioning is what you might call defensive growth, which is, analytically speaking, a bit of a contradiction.
Defensive growth.
Yeah.
Yeah, that sounds contradictory.
It is. The market's positioned as if growth is the safest place to be, and that assumption, well, can only last so long before the macro picture forces some kind of reckoning.
So the market's trying to rally on optimism, but it's fighting this rising tide of fear. What are the specific pressure points creating that macro wall you mentioned, the things holding back broader sentiment?
There are three very specific cross-asset signals just screaming nervousness. They really illustrate why institutional money is hedging so aggressively right now. First, the 10-year Treasury yield. It's recaptured that psychologically significant 4.00% level, closed at 4.01% yesterday. That isn't just some random number. It's a direct mathematical headwind for stock valuations. We'll get into that more.
Okay, 4.01% on the 10-year, and the second point of pressure.
The VIX, the fear gauge, right? It closed over 19.1 on Thursday. That was a jump of 2.8%. A VIX consistently near 20, that's the definition of heightened anxiety. Active institutional hedging. It signals that traders simply do not trust the stability of the current equity rally. They're buying protection.
And finally, the most recent and maybe most disruptive piece of macro news, that sudden spike in WTI crude oil.
It's exactly. Following the U.S. sanctions on major Russian energy companies, we saw that sharp, destabilizing spike in WTI crude futures. That oil spike is probably the most immediate, tangible threat to the current inflation narrative because it acts like a direct tax on consumers and businesses globally. This isn't just abstract fear. This is priced-in fear and immediate cost pressure, which brings us directly to the central data point of the day that everyone hopes will resolve this tension, the CPI. Yeah, the CPI. It's not just a data point. It is, without doubt, the single most important data point of the entire day, maybe the week. It's the primary driver of Federal Reserve monetary policy. It determines whether their current, highly restrictive, higher for longer posture is actually working to bring prices under control or not.
Okay, given its criticality, what are the consensus expectations? What are analysts actually measuring the number against? And why focus on these specific figures?
So we're focused on the year-over-year September CPI. The consensus for headline CPI is plus 3.1%. Now, this is important because it represents a potential acceleration from the prior month's plus 2.9%. If inflation is actually reaccelerating, well, that implies the Fed is still behind the curve, even with all their hiking. And, 3.1% is still significantly above the Fed's long-term 2% target. So the pressure stays on.
And what about the core reading, the component the Fed supposedly cares about most?
Yes, core CPI. Analysts anticipate, and I quote, little chance of any relief for stubborn core CPI. That's excluding volatile food and energy. That core number tells a story of sticky structural inflation things like housing costs, services, wages. That's the stuff that's hard to wring out of the system. If core CPI remains stubbornly high, even if the headline number looks a bit soft, the Fed will likely maintain its hawkish stance. It signals embedded inflationary pressures, especially in the labor market and services.
This really feels like a high-stakes, almost binary risk event, particularly because of the market positioning we just discussed. It's either the catalyst for a sharp, relieving breakout rally, or it confirms the macro fear and triggers a major correction. Seems like not much middle ground. Let's map out the three major scenarios for the listener. Starting with the baseline. What does the current bond yield suggest is already priced in?
Right. Scenario A. The inline to slightly hot print, say 3.1% to 3.2%. This outcome is arguably already largely accounted for by the market's defensive positioning. That 4.01% bond yield, the VIX near 19, that reflects this expectation. If we see this number, you'll likely get a modest, maybe brief risk-off dip initially, just because hopes might have been tilted slightly toward a cooler print. However, that dip would likely be short-lived. The key implication is it confirms the status quo. The Fed probably stays on hold, no major change. And that means the market can quickly pivot its focus back to the strong earnings reports we've been seeing from individual companies. It becomes a bit of a non-event, allowing the micro-narratives to resume their fight against that macro tide.
Hang on. If scenario A is priced in by the bond market, doesn't that mean the risk is skewed entirely to the downside? To scenario B. Why should we expect a quick pivot back to earnings if that 4.01% yield is still sitting there throttling valuations?
That's a really sharp challenge, and it gets right to the heart of this tension. It's a fair point. The reason analysts anticipate a quick pivot back to micro-narratives under scenario A is, well, the market seems to have already factored in the cost of high interest rates for the near term. That 4.01% yield is the discount rate adjustment, effectively. If the number is merely in line, the thinking goes, institutional investors might say, okay, no new bad news, let's go back to trading what's working. And right now, what seems to be working, or at least attracting flows, is Sanofi's pipeline, Tesla's narrative, things like that. The risk is absolutely high, but the institutional thirst for performance, for finding something that works, is arguably higher. It's a bit of a relative game.
Understood. Okay, now let's talk about the real danger zone. The scenario that confirms the macro fears and really forces the Fed's hand.
That is scenario B. A significant beat, a hot print, say above 3.3%. This would be the definitive risk-off catalyst, no question. It validates every fear about inflation reaccelerating. It confirms that the Fed's current measures might be insufficient. This would immediately shatter any lingering Fed cut hopes. Heck, it could potentially even bring rate hikes back onto the table, however unlikely that seems right now. And this number would be amplified intensely by that recent oil spike we discussed. Traders would immediately anticipate at higher crude, pushing future CPI numbers even higher in the months ahead. It becomes a vicious cycle expectation. And the concrete market implication of that hot print, what happens to bonds and stocks? The bond market would instantly sell off. Yields would push sharply higher. You can see the 10-year move well past 4.10%, maybe even towards 4.20% pretty quickly. For equities, a significant sell-off. Mathematically, that higher risk-free rate aggressively increases the discount rate used to value stocks, especially growth stocks whose earnings are way out in the future. The NASDAQ 100, despite its pre-market strength today, is the most rate-sensitive index. Its current micro-resilience narrative would just be completely overwhelmed by the macro reality of higher borrowing costs and destroyed present value calculations. It would likely force a capitulation, a washout of that growth trade.
Rough. Okay, and the flip side. The alternate counter scenario, the unambiguous bull case. The one everyone secretly, or maybe not so secretly, is hoping for to kick off a year-end rally.
That's scenario C. A miss, a cool print, say below 3.0%. This is, simply put, rocket fuel for the markets. Pure adrenaline. It validates the highly debated disinflation narrative. It suggests inflation has peaked and is truly rolling over faster than expected. The bond market would celebrate instantly. Treasury yields would likely tumble as bond traders start aggressively pricing in future rate cuts, not just holding steady, but actually cutting, perhaps even by Q1 of next year. That thinking would come back fast.
And for equities under scenario C.
This outcome would ignite a powerful, broad-based risk-on rally. It combines perfectly with the positive corporate earnings momentum we've already observed, like with Sanofi. A rapid decline in the 10-year yield removes that mathematical pressure on valuations. It immediately boosts the present value of future earnings for growth stocks. So the NASDAQ would likely soar, and you'd probably see the previously lagging Dow get dragged along for the ride as liquidity flows back into the system more broadly. A sigh of relief rally.
So in essence, the market is positioned defensively for scenario A, nervously hedging against the downside risk of scenario B, and utterly dreaming of the relief from scenario C. That tension is why we see such selective, almost tentative gains this morning. It makes sense.
Yeah, and to truly understand the market's current mood, its real anxiety level, we have to look beyond those selective equity gains. We need to delve into the hard evidence of macro anxiety that's holding back the broader market. Let's start with the VIX again. It closed at 19.12. That was a jump of plus 2.80% on Thursday. This isn't just a number, it's a powerful behavioral signal.
And you highlighted something critical earlier, this bearish divergence. The VIX, the fear gauge, rose 2.8% on Thursday, while the S&P 500 simultaneously advanced 0.6%. Explain again why that simultaneous move is so, well, damning for the bullish case.
Right. In a healthy market, a high conviction market, the S&P goes up, and the VIX goes down, they move inversely. That's normal. When they move together like that, it means institutional traders were actively buying protection. They were buying put options, VIX futures, other derivatives, essentially hedging their bullish equity positions as the market was rising. This signals they distrusted the underlying equity rally ahead of the CPI release. They were using the up move to establish bearish insurance, believing any gains were temporary and vulnerable to the macro news. It's clear evidence of institutional fear being bought at scale, not confidence.
Okay, so if the VIX is signaling immediate short-term nervousness, the 10-year Treasury yield is signaling more structural, longer-term conviction about inflation persistence. The fact that it's recaptured 4.00% and closed at 4.01%, why is 4.00% such a powerful psychological barrier beyond just being a round number?
Well, 4% represents a highly competitive, genuinely risk-free rate of return. For the better part of a decade, investors accepted returns far, far below this threshold because there weren't many alternatives and inflation was low. When the 10-year yield is sustainably over 4.00%, the bond market is essentially shouting that inflation is persistent enough and expected to remain persistent enough to justify such a high guaranteed return. It means bond traders are definitively pre-positioned for a firm or even hot CPI print. They're pricing in stubbornly high inflation that necessitates higher long-term bond yields to compensate investors.
And the implication of that for the stock market, can you explain again, just precisely, how that yield acts as a direct, measurable headwind? Make it really clear for the listener.
Sure. Think of it through the lens of valuation, how stocks are priced. Stock valuations, especially for growth and technology companies like those dominating the Nasdaq, they rely heavily on discounting their future projected earnings back to today's present value. The rate used for that discount calculation, the discount rate, is intrinsically linked to the risk-free rate, which is largely dictated by that 10-year yield. So when the 10-year yield moves from, say, 3.5% up to 4.01%, that higher discount rate aggressively reduces the present value of earnings projected 5, 10, or 15 years out. It makes future money worth less today. The higher the risk-free rate, the less attractive those distant earnings become today. This upward pressure on the discount rate directly reduces the justified multiple, the PE ratio, for growth stocks. It makes the Nasdaq's current pre-market outperformance look particularly precarious, maybe more momentum-driven than fundamentally justified at this exact rate level.
Okay, that makes sense. It's a direct mathematical hit. And then we have the global event that kind of came out of nowhere recently to complicate things further, the oil shock. WTI crude surged plus 5.4% to $61.65. What exactly was the geopolitical catalyst, and what kind of feedback loop does this create for the inflation narrative?
The catalyst was the U.S. announcing new sanctions on major Russian oil companies. The market immediately interpreted this as a potential reduction in expected global supply, or at least a disruption, pushing prices sharply higher. What this creates is a pernicious negative feedback loop for the market. It really amplifies that macro anxiety.
Okay, walk us through that cycle, step by step. How does it work?
All right. First, you have the geopolitical event triggering a supply shock spike in oil prices. Pretty straightforward. Second, that oil spike feeds directly and almost immediately into future inflation expectations. Oil costs permeate everything: transport, manufacturing, plastics, fertilizers for food production, heating. It's everywhere. Third, that rising inflation outlook reinforces the Fed's higher for longer stance. They simply cannot ignore a major inflationary shock like that, even if it's supply-driven. It complicates their job immensely. Fourth, that reinforced hawkish outlook places renewed upward pressure on Treasury yields as the market prices in a potentially longer fight against inflation, which finally applies renewed pressure back onto equity valuations, completing the loop. So, this self-fulfilling cycle of macro anxiety means the market is reacting to future inflation today, even before this morning's CI is released. The fear gets priced in immediately.
Wow, it really seems like almost every corner of the market, outside of maybe a handful of those mega cap tech stocks, is just flashing red warning signs right now. And even the traditional hedge assets seem to confirm that worry.
That's right. If you look at the traditional hedge assets, they absolutely confirm the institutional concern. Gold futures are trading around $4,130 an ounce. This price reflects persistent demand for a traditional hedge against two simultaneous risks: inflation eroding purchasing power and the rising geopolitical risks stemming directly from those sanctions and other global hotspots. Traders are seeking safety in assets that are hopefully uncorrelated with general market stress.
Meanwhile, Bitcoin continues to trade around, what, $110,000? While obviously highly volatile, it seems to act as a high beta proxy for pure risk appetite.
Exactly. It confirms that when risk sentiment does tentatively return, even briefly, money flows very quickly into the highest beta, most speculative assets. It reflects the pockets of, let's call it, froth and belief in future narratives that persist in the market, despite the severe macro pressure elsewhere.
Okay, we've painted a pretty bleak picture of the macro environment there. Now let's shift the tone a bit, because despite this, towering wall of macro fear, we are seeing fantastic evidence of corporate resilience, those micro shields you mentioned that are actively pushing back. And the best example overnight seems to come from Europe with the pharmaceutical giant Sanofi.
Yes, Sanofi's Q3 actuals really set a powerfully positive tone this morning. They perfectly illustrate the power of patented innovation, of having something unique to insulate a company from macroeconomic headwinds. When a company can deliver a product that truly no one else can, its pricing power and demand can become remarkably inelastic, almost disconnected from the broader economy.
Give us the hard numbers then. How strong was the beat, and what specifically were the drivers behind it?
Their sales grew a solid plus 7.0% at constant exchange rates, and their business EPS, the bottom line, increased by an impressive 13.2%. That's strong growth. And critically, they also reiterated their full-year guidance for low double-digit EPS growth. That's a huge signal of confidence in their own pipeline, their own business execution, regardless of whether the CPI comes in hot or cool today. They're effectively saying, look, our business is not dependent on the Fed's next move. It's a powerful message.
And the specific product driving this fundamental resilience, you mentioned one earlier.
Yes, their blockbuster drug Dupixent. Its sales surged an incredible plus 26.2%. It crossed the enormous 4 billion quarterly sales threshold for the very first time. That's just one drug generating massive revenue. Plus, sales from their new pharmaceutical launches overall rocketed plus 57.1%. So the pipeline is working too. The takeaway here is crucial. Companies with strong patented product cycles, true unique offerings are delivering significant tangible growth. And that growth seems effectively insulated from the general macro headwinds of inflation, high energy costs, or consumer trade down that might be plaguing other industries. This is structural, true micro-resilience in action, not just hope, but actual results.
Okay, now contrast that structural strength, that fundamental strength, with
Yeah.
the case of Tesla, TSLA. Tesla is also helping lead the NASDAQ rally this morning, but for fundamentally different reasons, it seems. It's a fascinating study in market structure versus pure fundamentals.
Indeed. It's a very different story. Tesla reported a Q3 EPS missed $1.50 versus the $1.54 consensus, and a dramatic 37% drop in profit year over year. Now, based purely on those metrics, a defensive blue-chip company, maybe like the Procter & Gamble we'll discuss later, would likely be severely punished by the market. Down hard.
Yeah, the stock reversed sharply. It rallied plus 2.3% pre-market, building on yesterday's 2% gain after the numbers. How do you rationalize this miss and rally dynamic? Isn't that just classic FOMO, fear of missing out, overriding sound analysis?
You raise a vital point, and it's the crux of the issue. The difference between Sanofi and Tesla is that Sanofi is demonstrating structural resilience based on current products and profits. Tesla arguably is demonstrating narrative resilience. The rally didn't happen because of the automotive business, which is clearly struggling with pricing competition and margin pressure right now. The rally happened because investor focus successfully shifted away from those weak automotive margins, the short-term fundamental problem, and towards the long-term potential of AI and robotics, particularly the Optimus humanoid robot program. The future story.
So the market isn't really valuing Tesla as a car company right now, but more as a future tech, AI, robotics company. Is that the idea?
Exactly. That seems to be the prevailing dynamic. This signifies that for this specific cohort of megacap stocks, the so-called Magnificent Seven, there is such a deep well of buy-the-dip capital available. It's driven by long-term belief, immense market momentum, and maybe a lack of other compelling growth stories. And that allows short-term fundamentals like missing earnings to almost take a back seat. Investors seem willing to pay an extremely high premium for the potential of the narrative, the dream of the future. This creates a sharp divergence between these few names and the broader, more fundamentally driven market. It's largely a momentum trade sustained by narrative, not necessarily a reflection of current fundamental value proposition in the traditional sense.
Interesting. Okay, and to provide a final, maybe more subtle but important global tailwind, you mentioned supportive data coming from Asia. Specifically, Japanese inflation data, while mixed, is actually helping global risk assets in an unusual way.
Yes. This is the kind of nuance that often gets overlooked by traders focused purely on the US CPI number, but it matters for global flows. We saw the headline CPI in Japan rise from 2.7% to 2.9%. Okay, on the surface, that sounds inflationary. However, the critical core inflation metric, this is the one that excludes both fresh food and energy, the really volatile stuff, that metric actually slowed down. It went from 3.3% down to 3.0%.
Okay, why does that specific core metric slowing down in Japan matter so much to, say, a U.S. trader focused on the dollar and risk appetite here?
Because that core metric strips out all the extreme volatility and arguably gives us a truer sense of domestic structural inflationary pressures within Japan.
Yeah.
Since that number is slowing, it signals the Bank of Japan, BOJ, has no immediate pressing need to pivot away from its long-standing ultra-loose monetary policy and enter some kind of aggressive interest rate hiking cycle. They can stay patient.
And if the BOJ stays loose, stays easy.
That reinforces the weak yen narrative. And a weak yen historically feeds the global carry trade dynamic.
Right, the carry trade. Can you simplify that quickly?
Sure. Basically, the carry trade is when investors borrow currency very cheaply, in this case, yen, with near zero interest rates to fund investments in higher yielding or higher growth assets elsewhere in the world, like U.S. stocks or commodities. As long as the BOJ keeps rates near zero and doesn't signal aggressive hikes, global investors can keep utilizing this cheap funding source. This flow of money out of yen and into global assets provides a subtle but important global tailwind. It acts as a source of global liquidity that partially counteracts the very hawkish narrative we're getting from the U.S. Federal Reserve and other central banks. It's a cross-current. Now, shifting back to the U.S., today's earnings reports are more than just about individual corporate performance. They are real-time barometers of the overall economy. They will either confirm or refute the message we get from the CPI. And the first one up, reporting at 8:30 a.m. Eastern, right alongside the CPI release, is the giant Procter & Gamble, PG. This is our premier read on the health of the global consumer and the true impact of inflation on household budgets.
Yeah, P&G is famous for its pricing power, right? Its ability to pass along higher costs without losing too much sales volume. But the expectations here, as you hinted, sound concerning. They suggest that pricing power might finally be stalling out.
They are deeply concerning, yes. The consensus EPS is $1.90. Now, that represents a negative 1.6% decline from the prior year's quarter. A decline. Now, here's the crucial analytical focus. This decline in profit is expected despite a consensus for a plus 1.9% increase in revenue.
Revenue up, but profit down. That is, as you said earlier, the textbook definition of a stagflationary signal, isn't it? Squeezed margins.
It is the clearest stagflationary signal you can possibly get for the consumer staples sector. It implies one of two things, or maybe both. Either P&G's vaunted pricing power has completely stalled, and they simply cannot fully offset rising input costs like that oil shock we discussed, energy, transport, packaging, or, critically, it suggests consumers are starting to seriously trade down.
Trading down. Meaning what specifically? Not just buying cheaper beer, but...
Yeah. It means the average household is making painful choices. This isn't just about switching from premium Tide to a store-brand premium detergent. This could be people switching from Pampers to private label diapers, Bounty to generic paper towels, Folgers to store-brand coffee, basic goods. That decision hits P&G's gross margins hard because their national brands, their premium brands, are where the bulk of the profit lies. Much higher margins there. So the key analytical focus on their 8:30 a.m. earnings call will be two metrics. Organic sales volume, is volume flat or worse, actually negative? Are people buying less stuff? And second, gross margin performance. How badly are margins being squeezed? A significant volume miss or severe margin compression would have negative read-throughs for the entire consumer defensive sector. It would suggest the consumer is finally reaching a breaking point, signaling real economic exhaustion.
Okay, a lot writing on P&G. Then moving to just after the market open at 9:00 a.m. Eastern, we get General Dynamics. GD, you mentioned this company offers a unique dual read on the economy, giving us insights into two very different global forces.
Absolutely. GD provides insight into two distinct and currently highly relevant segments. First, its Gulfstream division. They produce those high-end corporate jets. Gulfstream is often seen as a leading indicator of high-end corporate sentiment. Are C-suite executives, our boards, confident enough in the economic outlook to place orders for multi-million-dollar business jets? A strong Gulfstream order book signals robust corporate confidence and maybe future capital expenditure plans.
Okay, that's the corporate confidence side. And the second dimension.
It's Defense Systems Division. This is a strong barometer of government spending and, importantly, geopolitical risk perception. Given the recent Russian sanctions we discussed, the ongoing Ukraine conflict, and just general global tension, a strong report from their defense segment signals continuous government commitment to long-term defense spending. It reflects that macro anxiety turning into actual orders. The consensus estimates are for $3.73 in EPS and $12.53 billion in revenue. If they beat expectations, especially on the defense side, it strongly suggests that the macro anxiety we talked about is translating into immediate, measurable business for the defense industry. Geopolitical risk becoming revenue.
Got it. Then, a bit later, at 10 a.m. Eastern, we hear from HCA Healthcare. HCA, a major hospital operator. This feels less like a macro signal about overall GDP and more like a really detailed snapshot of the U.S. labor market and consumer health, maybe closer to the ground level.
That's a good way to put it. HCA is a vital proxy for U.S. healthcare utilization and, importantly, the financial health of the working class and middle class. We need to watch their commentary very closely for signs of two types of economic stress. First, labor costs. Are nursing and staffing costs still rising rapidly and eroding their margins? Healthcare staffing has been a massive cost headwind for a while now. Second, and perhaps even more telling for the broader economy, is the payer mix.
Okay, explain the payer mix. What is that telling us?
Payer mix refers to the ratio of patients they see who are covered by high-margin commercial insurance, usually through employers, versus those covered by government programs like Medicare or Medicaid, which pay less, or even worse, the uninsured, who often result in bad debt. If HCA reports a negative shift in that mix, for instance, a noticeable move away from lucrative commercial insurance towards more uninsured patients, that is a direct signal that economic stress is hitting lower to middle income consumers. It could mean people are losing job-provided benefits due to layoffs, or maybe small businesses are cutting back on coverage due to cost pressures. That's a clear signal of underlying economic stress that often precedes broader slowdowns in retail spending. It's canary in the coal mine.
Right. And it's probably important to just briefly contrast these sober, economically vital blue chip reports with the kind of high volatility we're still seeing in the purely speculative corner of the market. The source material highlighted Beyond Meat, BYND, collapsing, what, negative 20.7% yesterday after a recent meme stock type rally.
Exactly. That kind of wild gyration signals that a persistent pocket of high-risk, non-fundamental trading continues to exist. This speculative froth seems to be operating completely divorced from economic fundamentals, from CPI numbers, from interest rates. It's a battle playing out. You have highly disciplined institutional hedging, which we discussed with the VIX and Treasury markets, trying to manage risk. And then you have this continued retail and speculative momentum driving these high volatility, often low fundamental trades. The market is truly fighting itself on multiple levels right now.
Okay, we have spent almost all this time focused intently on the 8:30 a.m. CPI print today, but we really need to pivot now and remind ourselves, and you, the listener, that today's events are only the starting gun. It's just the beginning of a much larger inflationary picture unfolding. So what does the CPI print today, whether it's hot or cool or right in line, actually mean for the immediate future? Does it settle things?
Well, that's the key point. It means today's CPI is only part one of maybe a two-part or even three-part inflation story just for the next week or so. We absolutely must prepare for what the briefing called a super week ahead. That's basically running from Monday, October 27th through Friday the 31st, Halloween week. The market faces a critical gauntlet of potentially regime-defining data releases that could easily reverse or maybe amplify whatever reaction we see today from the CPI. If CPI is the preliminary test, next week is the final examination for October's inflation story.
Okay, a super weak gauntlet. What are the key items in this macro gauntlet we need to be ready for next week? The things that could really shift the entire inflation narrative again.
The focus shifts intensely towards the end of the week, specifically Friday, October 31st. We get two massive inflation-related reports then. First, the Employment Cost Index, ECI. The ECI is arguably the best measure of sticky wage inflation, the kind the Fed worries about the most. Why? Because wage growth tends to be slow to reverse once it gets going, and it feeds directly into structural service sector inflation, which is hard to control. If the ECI comes in hot, it really solidifies the case for the Fed staying higher for longer.
Okay, ECI for wage pressure. And the second big report on the 31st, the one the Fed truly prioritizes over CPI.
That is the core PCE price index, personal consumption expenditures. Understanding this distinction is really vital for listeners trying to gauge the Fed's reaction function. The PCE is a broader basket of goods and services than the CPI, and importantly, its methodology accounts for consumer substitution. Meaning, if steak gets really expensive and people buy more chicken instead, the PCE calculation weights chicken more heavily, reflecting that real-world consumer behavior shift. The Fed believes this provides a smoother, more accurate reflection of underlying inflation trends compared to the sometimes more volatile CPI. Therefore, a surprisingly soft core PCE print could easily override market concerns from a hot CPI print earlier in the month, and vice versa. It's the Fed's preferred measure, so it carries huge weight.
And we also have global central bank actions happening simultaneously next week, adding even more layers of macro complexity to the mix.
That's right. We're scheduled to hear interest rate decisions from the Bank of Canada, the UPO, on Wednesday, October 29th, and then the European Central Bank, ECB, on Thursday, October 30th. These decisions are crucial for global risk sentiment. If, for instance, the ECB signals it's definitively done hiking rates, maybe even hints at future easing, that could strengthen the euro and ease global financial conditions somewhat. That would be supportive for risk assets. Conversely, if the Bank of Canada continues with surprisingly hawkish rhetoric, it reinforces the global theme of tight credit conditions. These decisions will impact global liquidity flows and exchange rates, adding more volatility to the picture just as we digest the U.S. inflation data.
And on top of all that data, we also hit the absolute peak of Q3 earnings season next week. And several key reports look like they will provide a simultaneous critical read on the economy, perfectly aligned with that inflation data.
Exactly. Look at the names reporting that directly intersect with that core PCE report, which measures consumer spending. Visa, V, and PayPal, PYPL, are key reports to watch next week. Their results, and crucially, their forward guidance will provide a direct, real-time read on the consumer spending and payment volumes that the official core PCE report is trying to measure historically. If Visa shows transaction volume slowing dramatically, especially in discretionary categories, or if PayPal talks about less spending velocity, that tells a major story of a cooling consumer economy. That could validate disinflationary hopes, regardless of what the ECI wage number says earlier. It's real-time spending data.
And given the dramatic spike in crude oil we just discussed, triggered by those Russian sanctions, we really need to pay forensic attention to big oil's earnings next week, too.
Absolutely critical. The reports from ExxonMobil, XOM, and Chevron, CVX, next week will be vital for assessing the near-term and maybe longer-term impact of those sanctions. Their guidance, their outlook for Q4 and beyond, will be the very first public commentary from major players, incorporating the immediate impact of those new Russian sanctions and the subsequent crude oil spike we saw. We'll learn how quickly they are revising their production outlooks, their cash flow projections, maybe their capital expenditure plans based on this new geopolitical reality and higher price deck. They will essentially provide the immediate profitability forecast derived directly from that macro anxiety event.
Wow. Okay, so this really highlights that regardless of whether CPI is hot or cool today, the market has absolutely no time to relax. The immediate volatility today just sets the starting point, the baseline, for a week of critical, potentially regime-defining events. Events that will ultimately determine if micro-resilience can truly win out over macro anxiety for the rest of the year. Okay, let's try to synthesize the core tension one last time for you, the listener, as we head towards that crucial 8.30 release. We have a clear and, frankly, unsustainable divergence right now. On one hand, you have deeply bearish macro positioning. The VIX near 19 signaling fear, the 10-year yield back over 4.01% acting as a valuation anchor, the sudden oil shock adding cost pressure. Butting up against that, you have bullish micro sentiment in pockets, exemplified by Sanofi's genuinely insulated growth and the powerful, almost detached narrative resilience of the Nasdaq's mega caps like Tesla, rallying despite fundamental misses.
That tension, that push and pull, it simply has to resolve. And the history of these kinds of market bifurcations suggests it will likely resolve with significant volatility. One side has to give, eventually. The market's fundamental direction, not just for today but likely for the rest of the year, will be determined not just by the CPI print in the next hour or so, but by how the market collectively processes this entire super weak gauntlet that follows. The ECI, the PCE, the central banks, the key earnings, it's the whole package.
Yeah, the outcome of today's CPI will certainly ignite a rally or cause a sharp sell-off in the immediate term. That seems unavoidable. But the market's staying power, whether that move sticks, will be tested almost immediately by the PCE, the ECI, and the guidance from those oil and payments giants next week.
Exactly. And maybe here's a final provocative thought for you to consider as you digest today's news flurry, especially that P&G coming out simultaneously with CPI. We know the geopolitical risk from the sanctions caused the oil spike, driving up costs for pretty much every business globally. That's the macro shock. But if the P&G earnings report coming out right now confirms that expected margin compression story where revenue is up slightly but profit is actually down, does that mean the entire consumer defensive sector is now fighting both rising input costs, the macro oil shock, and potentially crippling consumer exhaustion, the micro lack of pricing power due to trade downs? If P&G confirms that double threat today, are the traditional safety stocks actually safe anymore? It could fundamentally change where defensive capital needs to be positioned for the next quarter. It's a really fascinating collision of macro and micro forces hitting potentially the most defensive sector simultaneously. Something to watch very closely.